It is the 2nd of May, a Sunday. It is exactly 3 p.m. GMT or UTC. For those of you that have made it, thank you. We will try and keep this, at least the first part of this presentation, short, which goes over Spectre's involvement in this. Before I proceed, please take a moment, as always, to read the disclaimer. Okay, so the agenda for today is to give you a quick summary of the investment that we have taken in Solar Oil's token, and also then to go over a rather detailed scope of the project, and Hitesh, who is their CEO, will be going over that. So I'll be handing over the floor to him. And then we will have a discussion about the risks and the perceived risks, because it is a risky investment. And then we'll go a little bit over a project, an initiative that we will be starting soon, jointly as companies, and then eventually as a group of companies. And then we'll have, of course, a Q&A at the end, as always, where you'll have the opportunity to ask questions. So what exactly has happened? If you recall, around a month ago, maybe 3 weeks ago or something, we put out a press release that we made a strategic investment in the digital token of an oil extraction project known as Solar Oil Project. Short form is SOP. SOP uses newer, more efficient technology in extracting crude oil, and it sells this offtake into the oil markets. The extraction is largely limited to abandoned oil wells across a range of geographies and is more cost effective than traditional pump jack wells. And to your right, there is a schematic that you will see, which basically shows you how a traditional pump jack well looks like. Most of these are onshore, and they vary in sizes. They can be as big as a small room, and of course, much, much bigger as well. The investment size that we had made was around 200,000, and therefore representing a relatively small portion of the DALP's AUM, but with a reward to risk ratio that is asymmetrically skewed in favor of a positive ROI over time, and a significantly positive ROI if oil remains broadly where it is. Please also note that in the wider framework of our investments as a group, this adds to the Rubicon strategy, which we already initiated last year in Q3, and which has already borne significant fruit, especially as Bitcoin and Ethereum have continued to rise. Now, this specific investment in SOP's token has a returns horizon of 240 months, and all cash flows will go towards converting the oil revenues from this investment to the market buying of the Spectre dividend token, which is known as SXDT. It will be bought predominantly on Spectre exchange. One of the primary goals is to add liquidity to Spectre exchange over the years. And it's also worth noting that it's not the only avenue where the market buying will be happening. Because because SXDT is going to be listing on a few exchanges, with the next one on the 7th or 8th of May, roughly speaking, we believe that this will not be limited to Spectre exchange. Now, the first cash flows have already come in. The quantum is small, but not insignificant. It's almost 1% of the investment made, so it's around $2,000 to $3,000 already. And we will be purchasing 20,000 SXDTs at a current market price of whatever it is right now, 14 to 15 cents. And you will be able to track this on a monthly basis on the Spectre Exchange website under the investor section. And we also can say with a relative degree of comfort that because of the way it is structured, because of the compounding options that we have selected and the assumptions we have made in the SOP model, these cash flows will increase from here on out, month by month, and really peak in the out months. There are three possible scenarios subject to geopolitical, supply side, regulatory / legal, and other project and industry specific risks that we have taken into account in order to construct these scenarios. Now, the scenarios I will not go over here. There's a detailed press release that was written about this. If you need access to this, you can email investorrelations@spectre.ai. It's actually ir@spectre.ai, and the team will be happy to send you that article. But it's also, I think, already well distributed amongst the community. Now, the base situation when we made the investment was an oil price assumption of 60, and that's West Texas Intermediate, not Brent, WTI. And oil since then has actually ticked up, so it's gone up by around 3 to 4%, in fact a bit higher. So that's obviously good. But the base assumption is that it will remain at around 60 over the 240-month horizon. And of course, subject to lots of moving parts, such as geopolitical risks, supply side blockages, and more. This should result in a buyback of in the range of $9 million at market prices. Of course, if oil prices average much weaker and they fall to, let's say, the 30 mark on average over this investment horizon, then the buyback would be just shy of $1 million. And of course, should oil prices track above the base case assumption as they are now, and should they reach something like 75 to 80, which is where Goldman Sachs has put their price target for the I think the short or the medium run, then the buyback is substantially higher than 9 million. And again, the detailed figures are in the article if you want to see. So I think the prudent assumption here is for us to assume it will track somewhere in between the bear and the base case. But of course, we live in a somewhat crazy world, and we have seen oil spikes before that are unrelated to demand growth that can, of course, cause serious price spikes, which can also leave the commodity trading at a much higher level for a long time. And that flows through to our margins very quickly. So with that in mind, now I will give the floor over to Hitesh. And Hitesh, please go ahead and explain to everyone SOP.
Sure. Thank you very much, Kay. As always, very nice and pleasant introduction and breakdown of what we have started doing so far.
Sure.
So just to give a very quick overview, and we'll go into some more detail and go into some more discussion here soon. SOP is part of the Beyond Oil initiative. This is the first and the most important phase of Beyond Oil. And this is an initiative that is primarily centered around bringing much more efficient technologies, especially eco-friendly technologies, to commodity production markets. The most important one of them is obviously oil production. That has been a very significant topic of discussion and debate in the green energy community as well. And what we bring to the market is essentially eco-friendly green pneumatic pumping technology, which is very suitable for underutilized or almost abandoned, and in some cases actually abandoned oil wells. So SOP essentially issues a utility token named the SOAX token, which stands for Solar Oil Access. Users are able to purchase this token, and inside our platform, they're able to stake this token towards different oil well portfolios. The capital from these token sales then goes towards acquiring the equipment, connecting the manufacturers of the equipment, which is part of our company's ownership, connects this to the oil well operators. This equipment gets deployed, and in turn, a portion of the oil that is produced from these wells is distributed to all the stakeholders in the platform. The unique thing that we've been able to do that nobody seems to have done so far is the way this distribution occurs, which is in the form of a second token named SOPX, which is the Solar Oil Production Token. And this production tokens distribution is directly tied and dependent on the production of oil itself. So when we receive the report of 1 barrel of oil having been extracted and produced, that's when one SOPX token is distributed. So this makes SOPX essentially the only token on the market that is actively backed by real production of commodities instead of just reserves of commodities. I'm sure many of you have heard about different tokens out there that, or different coin offerings that basically say something to the effect of, we are backed by gold or oil or something. And what they mean is that they have reserves in the ground. And that doesn't effectively mean anything. It's an illiquid asset. It does not correspond to any kind of value to that coin or token. What we're doing is very different in the sense that this is directly related to the actual production and extraction of the commodity, which means it's based on actively usable liquid, and in this case, more than one ways of liquid production of commodity. So over time, we will be adding multiple additional commodities. Right now, we're focused on the oil production portion, but this will be adding on things like gold and natural gas here in short order. We are working on those at the moment. This is a very unique platform because much like Spectre, this is one of the few platforms in the blockchain space that is very focused on solving a real world issue. And it is based on sound business principles instead of just an idea about what we might be doing. Another very interesting thing about us is that we are very sound in the way we approach this. So we did not start this out and say, this is a good idea, let's go present this. This was actually developed and issued many years ago, and we have literally brought it to the token markets at the end of 2020. So let's walk through a little bit of why we believe this is such a tremendous asset to the world and especially to the blockchain community. So the scale of the oil and gas energy markets is absolutely massive. It represents roughly 4% of the global GDP, which is currently estimated to be somewhere between the 80 to 90 trillion dollar range, depending on which estimate you look at. And the crude oil market in particular is a very strong market because despite all the discussion about switching to something other than fossil fuels, the use of crude oil goes far beyond pure energy. It is used in tremendous number of industries. So light oil, asphalt, lots of different items and productions are actually dependent on crude oil, even in some part of pharmaceuticals. So this is a pretty large scale, easy to manage industry that is not going away in short order. This is not a small trend that in the next 10 years or 20 years will completely vanish. It will evolve and we will be evolving with it. So let's address what exactly the issue is that we are focused on resolving. And this is very easily verifiable. I would encourage all of you to do some research of your own if you would like. But essentially, there are millions of abandoned and underutilized oil wells currently in the United States and Canada alone. Especially if you look at just the southern US, you have hundreds of thousands of these oil wells, which are oftentimes leaking methane, they are leaking chemicals, they are leaking oil into the environment. They have many different ecological hazards that are honestly in some ways unaccounted for so far. And this is constantly increasing. And at this point, the estimate has gone up quite a bit, where it is expected that somewhere in the range of $120 billion is going to be spent in Texas alone purely on cleanup. Okay, and that's just cleaning up these wells and then shutting them off. We're not talking about turning them into something productive, which is what we are doing. So let me define the problem in a very easy sense. You have relatively inefficient technology that has been around for a very long time. You have pump jacks that have been used on these wells, in some cases for decades. And this technology is not as efficient as what's available out there. Now, anytime the price of oil goes down, it results in many of these pump jacks being turned off, and they'll never be turned back on because it's just too costly to turn them back on, to do the maintenance on them, to do repairs, and so on. A very simple analogy that I believe everybody on this call would understand is Bitcoin mining. If you have an inefficient Bitcoin miner, when the cost of electricity goes up or when the Bitcoin price goes down, people who are on the margin, they have to turn those Bitcoin miners off. And then 3 months to 6 months later, when the price comes back up, it may not be worthwhile for them to switch it back on because there might be miners that need more maintenance. And if they were barely making any operating margins, it's simply not worthwhile to turn those back on. I think everybody on this call is familiar with the Bitcoin mining space a little bit more than the oil production space. But that's essentially what happens in this industry as well. Every time there is a fluctuation in the price of oil, which happens routinely, many of these wells get abandoned or turned off. And in most cases, they don't get turned back on. When they do get turned back on, they still operate at below the efficiency where they could be. Now, this was most heavily highlighted in 2020 because of the COVID pandemic. At the time, the price of oil cratered, and that created this massive opportunity, and why we took that time to really solidify this particular project. Because of the pandemic and the price crash, you have an incredible number of resources and assets currently available in the oil industry that we can go and partner with. And that's made it very easy for us to identify operators and identify these kind of assets that we can work with. So what exactly is our solution? We essentially help the operators take off their traditional pump jacks, which, like we've discussed, have a lot of moving parts. They're not as efficient, and we replace them with hyper efficient pneumatic pumps. And these pumps are much lower in terms of energy costs. They have no moving parts above the ground. It's a very sensible technological improvement, but like most things, it's a technological improvement that most operators are not even aware of. And because of the high efficiency, it's possible to power some of these entirely by solar panels alone, which is where we get the name, the solar oil project. So in many cases, we are able to essentially extract oil using solar energy alone, which is far more efficient, also reduces energy dependence, grid dependence, and so on. And in some cases, we're actually able to produce excess energy that we can sell back to the grid as well. So there are multiple things going on here that make this much more efficient and make this a very, very attractive solution for most operators. Obviously, this also makes it, from a regulatory perspective, much more likely to succeed in the long term, since there are a lot of regulations that favor green technology, that favor oil production, but with reduced carbon intensity and so on. So this is very good from multiple aspects. But one of the key things that makes this so powerful is the lowered cost of production. Because these pumps are so much more effective and so much more efficient, it's able to produce the oil at a much lower cost, which is where SOP generates the margin and why stakeholders and token holders inside Solar Oil platform are able to generate significant oil revenues over time. So let's talk about the project history very quickly. Like I mentioned, this has been, we have conducted this project in a slightly different manner than you usually see in the blockchain space. So the pneumatic pumping was patented in 2016, and it has been in active production and development since 2017. So these pumps have been deployed on sites, pulling out oil since at least 2017 in a prototype stage, and then advanced since then. With the number of partners and operators that we have worked with, we currently have access to about 170 million barrels of oil in reserves from our partners. We do publish these figures, this data, as well as the reports are available on our website, which we'll go over in a minute. In 2020, we decided to build the platform of Beyond Oil to tokenize this commodity production and bring it to the market. So we essentially took 3 to 4 years confirming that the production, that everything in the background was real, could be sustained and could be scaled up, learned quite a few things along the way, and almost all of this has been self-funded during that time. Now, at this point, as of April 2021, we released the commodity exchange, which essentially allows market trading of SOPX, just like you're able to trade WTI and oil futures and oil reserves in general. The commodity exchange on our platform now allows, for the first time, market trading of SOPX against other commodities and assets. So you actually have a mechanism that allows you to convert SOPX into anything else that is equivalent to the current price of oil. And that essentially makes SOPX a new available standard in the market. Just like WTI and Brent are standards of oil which can be traded in markets, SOPX is now also one of those standards, albeit it's in a very small sense at the moment, but we will be growing over time. So here are the clear benefits that we present. We bring increased efficiency to the market, result in much more significantly reduced carbon intensity in production, which is a very important aspect of this, why we believe this is so attractive to a lot of the operators that work with governments, as well as gives us access to potentially to significant public and state assets. It encourages solar power production, which we'll be able to sell into the grid over time. We're able to revitalize economies that have been very hard hit by the pandemic and some other things like that in the southern US especially. And then finally, this all results in significantly cleaner environment because we are getting rid of a potential major eco hazard. And it's an eco hazard that frankly has not been discussed nearly as much as it should be. Most people are completely unaware of how big of an issue this is because it's so outside of the general mainstream view. But all of these benefits combine together to make this a very significantly valuable project where you can actually look at this and say, this is what the value proposition is and how we are bringing additional value to the market. So the obvious next questions, hopefully at this point, are how do you participate and how does the whole platform work? So the platform is available to public. It's free to create your account. You just have to go to our website, which is solaroil.io. We will go through that here in a minute. You decide to purchase the access tokens. Access tokens are priced at a fixed, one token is 10 cents USD. That does not change. This is not a speculative token. This is a pure utility token. So this is not on open exchanges. You're not purchasing this token thinking that the value of this token is going to go up over time. That's irrelevant. You're only purchasing the access token to be able to stake it towards oil well portfolios so that you can receive oil production, which is your SOPX, which is the solar oil production token. Now, when you stake your access tokens, you will start receiving oil production as SOPX every day for the next 10 years. So each stake lasts for 10 years. And this 10-year term actually comes from the agreements that SOP does and Beyond Oil does with the actual operators on the ground. So most of these oil wells that are abandoned when the technology is deployed, we are looking for well sites and we're looking for operators that know that there's production for at least next 10 years from those sites. That's why the 10-year term is in that place. So this distribution will last for 10 years. At the end of those 10 years, your SOX will be burned. That stake will go away. And you can choose what to do with your SOPX at your own leisure. So the oil production, like I mentioned earlier, is tied directly to the production of oil. So every time there's a barrel of oil produced, a new production token is distributed, and you make the determination on whether you want to continue to hold that SOPX, whether you want to sell that, whether you want to trade that for a different asset. You might think that Bitcoin is going to go up much more in price. So you might choose to say, I'm going to, as my oil production comes in, I'm going to convert that into Bitcoin. You might think that I want a little bit of a hedge, and I think gold might be a good hedge for me. So you might choose to convert a portion of your oil production into gold and hold it as that. Or you might convert that into a fiat currency like USD or Euro and hold it in those forms because you feel the most comfortable with that. You can convert this at your leisure in real time. It's all determined by you. We do not participate in that. That is not a function of the Beyond Oil platform. And Again, you choose when you want to withdraw any of your gain value over time in any of these different currency formats. You can choose to withdraw that whenever you are ready. The SOPX token, one of the very interesting things about this, and hopefully many of you have shared this concern that I know Kay has and I have in the past about many blockchain platforms, is where does the price of the token come from? Especially the DeFi markets, there are significant concerns about market manipulation and so on. In our case, the global oil price, which is the WTI price, determines the value of the SOPX token in terms of redemption on our platform. So at the moment, the SOPX token is pegged to 60% of the WTI price. If the WTI price is 60, then the SOPX price is 36. And that's always displayed in real time on the side. And whenever you do the conversion, that's the rate that you're going to receive. Now, the reason why it's at 60% of WTI price is because of the significantly lowered cost of production on our side. Because SOP is receiving the oil production at a much lower cost than the WTI price, it's able to pass that difference on. And that's why this margin exists and why the user or the stakeholder is able to generate a margin and hopefully a significant profit over time. The obvious next question is going to be, what do we expect the price of oil to be? Where is it going to go? What is the expected production look like over time? There are quite a few different estimates out there. I think Kay mentioned Goldman Sachs giving a price target of around 76. JP Morgan has put out a target saying we're going to hit around $190 per barrel. Might not sustain it for a long time, but we are going to end up in that neighborhood for a short time at least. Internally, we are much more conservative. We are operating currently with the assumption of oil staying $60 or above is our baseline assumption. And then further out from that, we are looking at a potential estimated average of around $75 over the next 10 years. So on our website, you'll actually find this calculator that is available that you can use to figure out what this production looks like, what does the daily reward look like, and so on. So you basically plug in how many initial tokens you have available, what you believe the average WTI price of oil is going to be, and you have the option to do something which is akin to compounding. It's not truly compounding, but it's something similar, which allows you to automatically convert your SOPX as you're producing it, to convert some of that, to liquidate some of that, and purchase additional access tokens with it, which allows you to keep expanding your total number of access tokens that you hold, which keeps increasing month over month how much oil production you're receiving, which is what, again, Kay referred to in the beginning when he said every month we expect that the cash flows will keep building up a little bit. I want to discuss very quickly this field that you see here named expected oil production per 1 million SOX, okay, or we like to call it BPDM, barrels per day per million. This represents what we receive in oil production in the background from our operators. And we give guidance of using a figure of 1.5 in extreme bearish scenarios, 2.5 in standard scenarios, and 3 to 3.5 in very bullish scenarios. We are currently using 2.7 as the baseline. That's what we have been producing at the moment. We expect that to climb over time as the technology becomes more well adapted, well adopted, spreads over time, and we start working with more operators with better assets than what we're working with at the moment. We expect that to climb, but I would advise everybody to use 2.5 as a somewhat safe number. So you can see in this particular example, if somebody was to purchase 100,000 access tokens, which would be 10,000 USD, and they were to expect the average price of WTI to be 55 with absolutely no compounding with a 3.5 production, that would result in $42,000 worth of oil production over the next 10 years. Now, keep in mind, you don't wait 10 years to receive that amount. You will be receiving this amount daily over time, but it will be distributed over those 10 years. And that's where the 120-month value comes from. It's not a time period that you're going to wait. It is just going to keep adding up. So it'll add up over the 120 months to 42,000. So this right here is a very simple chart that breaks it down, and then we'll actually show you some comparisons of what it looks like with compounding as well. So this is if you are starting with 10,000 USD, like we just showed you in the example previously, $55 WTI price, and no compounding. Compounding here, just to be very clear, is not some form of interest. We're not talking about compounding interest. We are talking about you saying, I want you to take a portion of my oil revenue and use it to purchase more access tokens. It's very similar in the real world to somebody who does Bitcoin mining, for example, saying, I'm going to take 50% of my mining rewards and I'm going to purchase more mining machines so I can keep expanding my business. That's essentially what we're talking about here as well. So let's contrast this to what happens in different scenarios. So if you were to compound this, let's add in those figures and see what happens. So please go ahead. So this is the same scenario that we had before, which is 100,000 SOX tokens, $55 being our average expected price, but now we have added in 75% compounding, which means over the first 10 years only, you're taking 75% of the oil production and creating new stakes with it, okay? So now you see that the horizon for the completion of all these SOPX rewards goes from 120 months to instead 240 months. The reason for that is each time you create a new stake, that's going to last another 10 years. So when you create your stakes by compounding, when you create a new stake in month 120, which is the 10th year, it's going to last another 120 months. So this now changes it from a 10-year production to over a 20-year production. This is what you can expect. And you see how this changes the figures quite dramatically. It goes from being around a $42,000 range to $900,000 range. And this is a very, very significant portion of, I guess, a leg up that everybody who joins the platform in the beginning, who is working with us now, like Spectre, this is one of the benefits that you get, that being a user in the beginning allows you the ability to compound and grow as you bring more assets in. Now, when we talk about compounding, it is not going to be limited just to oil production. You will be able to say, as you bring other commodities on, you will have the option to say, I want to purchase more SOX tokens, but I'd like to stake some of them towards natural gas and some of them towards other things. Now, if the price of oil was to go up and go up to about $65 range, which is currently what we're estimating, in the exact same scenario with an average price of 65, that ends up being worth about $1.9 million worth of oil production, which again just kind of highlights how sensitive this entire project is to the core price of the commodity. So at 65, we more than double in some cases our total production value, and you can see that here. So the compounding effect can be configured in your account. This is not something you have to manually log in and manage yourself. You can simply select a setting in your back office, which is what Spectre has already done, where you basically say, this is what percentage of my oil production or oil revenue I want to convert to additional SOX tokens. It's very similar to the drip feature. If any of you use common apps that are used for financial management, like Stash and so on, it's very similar to that. You're simply saying that as oil production comes in, I want to convert my SOPX tokens to SOAX. We will be adding additional options here as well, where you'll be able to say, I want to convert some of it towards additional access tokens, but some of it I want to convert to Bitcoin, some of it I want to convert to gold, and so on. So we will be giving those options here in the near future as well. So common question we get is about the management team. Now, this is available on our website as well, and there is a pretty significant commodity management team in addition to this. You can see Hitesh, which is me right here on the as the CEO and CSO. And you can go through all of this on our website in a little bit more depth, but everybody on our management team has significant experience, people we have worked with for many years, and people who are very heavily connected to the kind of technological assets and the kind of partners that we would need. So we are approaching and speaking with pretty high-level partners in other major companies at the moment to try and expand our footprint as quickly as we can. You can see some of our partners on the commodity management side. Doug, who is actually one of the contributors of many of the oil wells and oil well assets. Gary, who is actually the patent holder on the pneumatic pumping technology, which is an issued patent. It's not a patent that's pending, it is an actual issued patent. And on the website, you will also see both the patent, if you want to see that, but also the oil reserve report. So you can actually see where a lot of these reserves are held, what are the locations that we are most likely to go after. And you'll find that currently we have over 170 million barrels of oil in reserves already listed. This will expand to around 250 million total barrels of oil once we finish our transactions with a few other operators that we're currently working with. So that represents a very significant opportunity to grow over time. An obvious question that most people should have is this a market that's scalable? Is this something we can grow into over time? And based on the assets that we have access to, based on how much oil we can go and work with, the answer is yes. Just the wells that we could currently target and work with, we could easily deploy somewhere close to $2 billion worth of capital. We are not doing that. Our phase one is limited to $200 million. That's what we're going to focus on in the beginning. So that's 2 billion SOX tokens. That's our phase one. But the opportunity to grow is absolutely massive here. So there are some risks that we want to discuss. There are a few different risks actually in here. The first one being the oil price. Now, the price of oil is a concern. It is always going to be a concern since it directly impacts the value of the SOPX token. It directly impacts what your earnings over the horizon look like. However, there are a few things that are very heavily in the Beyond Oil and SOP project's favor. The two major things in our favor are, first of all, that our price of production or our cost of production tends to be significantly lower than a lot of the other production at the moment, which means as the price of oil drops, a lot of the other oil operators would start going out of business before the operators that are using our technology, before they would be impacted. And that basically means that there is a buffer created in front of us. So whenever there is a reduction in the price of oil, other people would have to shut down their oil production before the fields that are using our equipment would, which in turn means that the price of oil would stabilize before it impacts us too heavily. So to address this in the calculator, I would advise people to use numbers like $40, even $45 to kind of see what would happen in a very low price environment. And you find that this still ends up being a profitable project. Regardless of the fact that the profits are much lower, it does still end up being a cash flow positive project. The second is the supply side risk. This is also a similar risk in the sense that there's obviously that risk that always exists. There are natural disasters that could happen. You could have hurricanes and things of that nature that can impact this. The good thing here is that because these pumps are extremely small relative to everything else, and they have no moving pieces above the ground, it makes the maintenance and it makes their ability to withstand these kind of natural issues significantly better than other technology. So it diminishes some of the supply side risk because of the nature of the technology itself. However, even so, there are going to be cases where operators might go out of business. There are going to be operators who simply have to shut down their fields for a different reason. They might have some of our pumps deployed and many of the other traditional pumps deployed. That tends to be the case, and they might not be able to sustain it. So in those scenarios, we would see a lower production coming in per million tokens. And to account for that, again, I would advise anybody to use the calculator, and in doing so, use figures of 1.5, 1.7, maybe 2, to see what happens in bearish scenarios where the supply side does not produce as much oil as we are currently doing or as much as we estimate. Finally, we have regulatory risks that in general hang over the oil production or commodity production markets, that there could be regulation changes coming out. Things, for example, that might come out and say, hey, we are going to ban drilling for oil in California. That is currently a proposal being discussed quite seriously. This actually works very heavily in our favor because our project is about going out there and revitalizing old wells and underutilized wells. We never undertake any oil drilling at all, which also eliminates a very significant economic risk in general. That tends to be the biggest risk in the market. So we have eliminated that risk to quite an extent. This is a green technology. This is all about cleaning up the environment as well. So the regulatory risk is somewhat mitigated, and it is heavily in our favor as well. And the final piece is the technological risk on what happens if the technology does not perform as we would like, and what happens if the blockchain markets don't perform as we would like, and so on. Hopefully, you guys have already realized that our core technology, the pumping technology, is very well studied, well patented, has been deployed for years. So that's been very well studied in terms of a risk. In terms of the blockchain markets, one of the good things about this platform is that we are not very heavily impacted by reduction in the price of Bitcoin, for example. In fact, in some ways that might work in our favor because people would gravitate towards real projects that are based on real world value and real world cash flows, which may actually work in our favor as well in those scenarios. However, nonetheless, that risk does exist. All of these risks are real risks, and they will and can impact your net production or your net gains or net rewards from this platform over time.
Okay. Thank you, Hitesh, for that. That was very comprehensive. I see a few questions already coming in. I want to ask a few of my own, and while we're on the risks section, can you tell me a little bit about subsidies right now? Does the SOP project rely on any sort of local, federal, or state subsidies at this moment that are, let's say, buoying your economics, or no?
No, so all of our economics are currently being discussed without those subsidies. We are not relying on them. However, those subsidies do exist, and our operators do receive them. That's one of the big reasons why a lot of these operators are so eager to work with us. Because when we go to them and say, we can replace these oil wells, you can have lower production and so on, lower cost of production, that's all exciting. But one of the things that excites them a lot is this also allows them to take significant tax reductions because of the subsidies that are available. So that gets built into the model because it allows us to more easily acquire or partner with existing oil well operators. But none of these figures that we have shared and our lower cost of production and so on, it does not rely on those subsidies, which is a key difference, right? Because those subsidies could expire or could change, and we don't want our economics dependent on it.
Definitely. Okay. And let's talk a little bit about oil price risk. So obviously, as per the latest research that has come out, I see your colleague Bill, who's on the call, has also left a message saying that the EIA, the U.S. Energy Information Administration, lifted 2021 forecasts for oil prices by 14% and has again raised its Brent and WTI intermediate oil price forecast for both 2021 and 2022. So that's obviously it's an opportune time for us to be doing this. My concern is always on the downside. So where we are geopolitically, quote unquote, I say the stunt that the United Arab Emirates pulled, I think it was last year, if I'm not wrong, right when COVID had started, and then of course with Russia coming in, where are you seeing that impacting oil? Do you think there's more risk to the upside or more risk to the downside? That's the first part of the question. And if, let's say, you are wrong, let's say that we're all wrong and we think, okay, oil prices may go towards the bearish scenario, so 30, 40. At what point does the SOP project not be profitable? At what point do you guys actually say, well, actually, oil now is at 20 or 25. This actually doesn't make sense anymore, this entire thing. Please go ahead.
Yeah. Sure. So first of all, I am not a prophet, so I cannot predict exactly what's going to happen in the future.
Sure.
And keep in mind that there are a lot of very good data sets available for the next 5 years, but anything beyond 5 years is a lot of guesswork, right? Because we don't know where things are going to go. And what we are discussing is average price over 10 years and average price over 20 years. which changes things quite a bit. That's one of the reasons why we are so conservative. If you look at majority of those data sets at the moment, they indicate a price of above $100 on average for the next 10 years. But we go with 60 because we are very risk averse. I think that's one of the reasons why you and I have gotten along for over the years. We both share that risk averse nature. So that's one of the reasons why we go with 60. Now, there is a price limit, right? That price limit is probably around $30 to $35 at the moment, where a lot of our operators would say, hey, even at the lower cost of production, this might not be worth it.
Right.
Now, we don't think that that's what's going to happen. Usually what happens in the background is that when the price of oil drops to below 45, a lot of the financing markets for oil and gas equipment, they dry up. And that causes a lot of the other operators with the traditional technology to not be able to function anymore.
Right.
So it creates a shortage in the market, and that lifts the price of oil back up. That's why even during COVID, the price of oil kind of sat around $36, $37 price point instead of going down much more, because it just cannot be done, right? Below that, you get almost zero production. So our operators can continue functioning in that space. The second thing is, as the price of oil collapses, it also starts reducing the cost of labor. It reduces the cost of materials and goods that are required to do these installs. So we might actually realize that when we do get to a $30 price environment, we might say, we thought we are not going to be profitable, but we still are, because there's such a reduction in certain costs. The same thing happens on the upside. And there is a risk on the upside that if the price of oil is around $110, $120, it makes our project slower. Because a lot of the operators who would be out of business or would be looking at our technology would then say, I don't even care, I'm gonna keep going. It's like a Bitcoin miner saying, the price of Bitcoin is at 100,000, I'm gonna use my old S9 miners. Even though they're inefficient, I'm still going to be able to make a profit. So there is also the risk that our project might slightly slow down in terms of its cadence, in terms of how many wells we can deploy and how much we can bring in, because we might see a shortage in materials that are required to install more wells. But that's a fairly minimal risk, but I do want everybody to be aware of it.
No, I think it's a very interesting risk to bring up. So it's almost like saying there's a price ceiling and a floor, and there's an ideal sweet spot, so to put it, however wide that range is in price, let's say above 45 and below 100, roughly speaking. Where you guys can grow at a healthy pace, where you're not going to get operators saying, well, actually, I'll just use my old pump jacks or whatever. And so ideally, in order for your project to operate at this cadence, as you mentioned, it would be ideally in this range, correct? Sort of 40 and above and 100 and below. That's interesting.
We like to say that 60 to 120 is that range. That's the perfect range for us.
Right.
Yeah. And honestly, this couldn't have been better orchestrated in our favor than what has happened in the last 1 year. You have had, because of the COVID drop, you had tremendous amount of these assets available at the moment, which were not available before. And everybody's very eager to look at the environmental impact of things now, more so than before.
Right.
And on top of that, now we're going to see this slow climb up, because as businesses come back online, travel comes back online. This is working out very well for us.
Yeah. And where is, if we had to take a kind of a 5-year view or something, looking at the futures market, there's two things I wanted to discuss on this. The net present value of the SOPX token, or let's say the SOX, which is actually the bit that the token holder would stake, that generates the SOPX redemption tokens based on actual production in the ground of oil. That has a net present value. Anyone who knows DCF can run that. They can run their assumptions, 2 forecast horizons, put in a terminal growth rate, whatever. Where do you see this trading, or this NPV, this net present value, relative to the actual perceived value that investors will be paying for this token in the next 3-4 years? So let's say things have really scaled up. I mean, you've already deployed quite a bit, but let's say it really scales up to 200, 300, 400 million or more in actual deployed capacity. What is the differential? Because, for example, the gold markets, right? People talk about the inherent inflation hedging capabilities of gold. the store of value capabilities of gold. But if you look at the paper market, the gold paper market, the ETFs and the leveraged products built on gold, this can trade at a multiple of 100 times. And you made
Exactly.
the point about gold itself. A gold-backed token is not really worth much. It's about the production that matters, right? So where do you, how does one go about computing that? Is it always going to be 10 cents per token? So I think that's what it is now, right? Yeah, go ahead.
Yes, SOX is going to reasonably, I feel fairly confident saying that, let's say that's going to stay at 10 cents within our platform. Okay. However, it does come down to what is the leverage being built by a carrier of a sort that we get picked up by. In those scenarios, if you look at, I think the best way to look at that is likely jet fuel markets is the best comparison to what we are doing here. That tends to be a multiple between 50 and 80. So we are looking at a potential leverage point of that level. And that's why one of our key focuses right now is really solidify the fundamentals of the business, make sure that this is doing really well, make sure the production is there. But then the next step is to package the production token, where instead of just redemption, it is actually being traded independent of the SOPX redemption value. And that it becomes a part of ETF style tokens or programs. And I know that leads a little bit into some of the stuff we want to discuss as well.
Yeah.
But that's one of the best ways to do it. And that is probably where the best value for this is going to come from, similar to what we see in all futures and such right now. In general, I'm very cautious about leveraged products because obviously you also are magnifying your risk in many cases. In this case, because we have a very healthy underlying redemption value, at least users are always aware, or traders are always aware, what the baseline case is. That this is the lowest possible, which is 60% of WTI. That's the lowest possible scenario for the value of this token. But let's call it the account value. So if you have an account that has 1 million SOX staked in it, you can very easily compute what the sale value of that asset would be. Right? It's very similar to saying if you have an oil well that's producing X amount of barrels of oil per day, you can compute that value. So this is going to be a very healthy market where you will start seeing people also buying and selling their accounts themselves based on their configurations and what they have available. And that will especially become acute when we release additional portfolios and we start limiting how many new tokens can be sold or new tokens can be purchased when we reach capacity on how many wells we can deploy. You'll start seeing a lot more of that.
Okay, so to understand, that's kind of the vision. And right now, obviously the SOX, which is the staking token, which is the account token, that cannot be traded. So once the investment is made, it's not like they can sell it back to you because you've obviously used the funds to build the pumps in the ground, correct? So,
that is correct.
So, but you're saying in the future, if I understood correctly, it is possible that there's two options here from the perspective of the person who has decided to invest, is to actually, I won't say ARB, but to actually sell on the actual right to earn on production, and the right being the staked SOAX, the account itself, and that itself can trade at some point. But then, of course, the SOPX itself, which is the actual production token, which is ERC20 right now, if I'm not wrong. And this cannot be moved off site right at the moment, if I'm not wrong, but eventually this is something that will be on Uniswap or wherever, on any sort of exchange, hopefully Spectre exchange as well someday. So this will have its own market. And that market, of course, if we're looking at jet fuel, which is, it's an example. It may not have too much relevancy to this, but that market could trade in theory either at a discount, unlikely because there's a redemption value, which is backed by oil on your platform and global oil markets, but it could trade at a premium to the actual redemption value is what you're saying, correct?
Correct. It would only trade at a premium because they would never go below what we are redeeming it for, since they would just come to our platform and redeem it there. And yes, everything you said is correct. But it is not as far in the future as you might be thinking in terms of being able to sell accounts and so on. We actually have users who created their accounts in December, and because now the price of oil has gone up, their accounts are worth more than they were in the past.
Right.
So there are users who are already coming in and saying, hey, I would really like to consider selling my account to somebody else. And we will also do something similar to actually incidentally, what you're doing right now with SXDT buyback, we will be creating something similar to that as well, because we do structure buyback options with our operators as well in the background, right? So we will be giving that option to our users as well, saying, hey, if at some point you want to exit, we have that capability.
So am I right in assuming that when we are in a scenario when SOP does have the ability to sell accounts, let's say in a formalized marketplace, not OTC sort of negotiation based, but formalized marketplace, relatively liquid. So if I, as a token holder, have invested X, right? Let's say whatever, $10,000 for example's sake. It's the same example that you use in the presentation, and that at a certain price, at a certain MMBT production assumption, let's say 2, whatever, and certain compounding is worth X amount in the next 10 years, correct? We know the theoretical value, and I as a token holder would need to wait and earn on a daily basis, and I need to wait till that becomes mine effectively those years. You're saying that, however, I have the ability to sell on my account. I could actually sell that. It's almost like factoring receivables. I could sell that account to someone else, but obviously for a significant haircut, I assume, but still much more than I've invested. So actually I could arb this. I could invest 10K today, things go well for a few months, and I could sell this for maybe 15K or something. So I make a 50% ROI already, but of course I forego my right to earn the entire return over the years, correct?
That is correct, exactly. You would be able to sell essentially your entire portfolio, right? That's exactly what you would be doing.
And what, would I be selling SOAX? Is that what I'm selling? I'm not actually selling my account password and login rights, right? What am I selling there?
You are selling the underlying SOAX, correct? So essentially that staking contract is what you're selling. It would move from one user to another. And we actually have those available in our back office. So we display each staking contract with its own ID. I think you've probably noticed that already.
Right.
And those contracts will be transferable between users. So it's very much like we are essentially building a secondary futures market around these staking contracts. So what you would be trading or selling would be the staking contracts, just like futures markets are selling production contracts for the future. So it's very similar to that. But keep in mind, I want to be realistic about it. You would see a spike in that value in relation to when we start shutting down some of the portfolios, right? When we say there are no more tokens being staked or no more tokens available at the moment, that's when you really see a big spike there.
100%. It just becomes more scarce, right?
Exactly.
Okay, so we have that. And just while we're on the futures curve, right now, are we in a situation of contango or are we in backwardation? I'm a bit, I haven't checked recently.
Yeah, I think we are still in a contango now.
Okay.
We were going backwards actually last month when I looked at it, but we are actually in a contango again.
Okay. All right. So we've discussed oil price risk, supply side risk. Now there is something that happened a few months ago. There was a massive storm in Texas or Louisiana, one of the two. Correct me if I'm wrong. And I remember that you guys were impacted, some of your operators, etc. Can you tell me how this played out? And can you tell me, see, from the perspective of a token holder or whatever, even Spectre, because when one is purchasing SOPX, I understand one is buying diversified production, quote unquote, rights to things. So it's not one, and over time, there'll be more investments made to diversify it. It's not like it's all in Louisiana or oil and all in one part of the UK. And so one is incrementally or decreasingly affected by any one of these events, these so-called force majeures. Is that correct? Is that assumption correct?
That is completely correct. Over time, we become more and more diversified.
Right.
So the bigger the project becomes, the better it is for all of the stakeholders involved, because our production starts coming from more and more locations.
Right.
So at the moment, our main portfolio is very heavily in southern US. We are looking at Louisiana, Oklahoma, and Texas. But Texas is vast. So within Texas, we have many different fields that we can tap into that we're already discussing. And it'll get better and better over time from that perspective.
Right.
Secondly, let me speak very specifically to the event that occurred. What that did primarily for us is that it slowed down our new installations. But I'm very happy to report that none of the existing pneumatic pumps were actually affected by those storms. those continue to operate, those continue to function properly, those still pumped out oil, it still went in. Now it slowed down the transportation, right? So we weren't having the trucks coming up to pick up the oil and things like that. But the core fundamental technology did keep working and did keep pumping. And again, this is a question of maturity over time. So right now, this is quite centralized in a way, if you think about it, right? And we are all about decentralization over time. So right now, this is very centralized because you are really interacting with our website, our platform. You're getting all this data from there. Where we are headed is deploying specific downhole sensors, where when you stake on a portfolio, you will be able to go and see every single well in real time in that portfolio, and what is the production from each one. And it's literally on a 2-minute lag. So you will be able to see 2 minutes ago, this pump ran and it moved 1.4 gallons of fluid, right? You could actually see all that data. So the reporting, instead of coming from oil well operators to us, would actually come directly from the oil well itself to us, which now makes it very decentralized in terms of reporting, right? So then it becomes more and more difficult for the data to not be accurate. So you'll be able to see, even in those scenarios, what's going on. Are the pumps still operating when there is a storm?
That's actually fantastic. So you've installed, if I heard correctly, sorry, I think the connection was a bit weak, but what you're saying is you've installed downhole sensors, which basically, and what percentage of the current asset base that has your pneumatic pumps on it actually has these downhole sensors, which are currently reporting back to very few? And how much, and you expect what type of penetration and percentage, let's say over the next 2 years or 3 years? Would it be close to 100%? Is this something I, as a token holder, can pay for, or no, because I get diversified access to all the...
No, you're getting access to a diversified portfolio, and a lot of these kind of discussions, specifically where we're going to deploy monitors and so on, comes down to each operator, right? Which operator is willing to play ball with us, work with us, and experiment a bit.
Right.
Our goal is to reach 50% penetration in making sure that we have all of these downhole sensors in place. The goal is 50% by the end of year 2 and 100% by the end of year 5.
Okay, understood. Okay, technology. Could you tell me a little bit about the pneumatic pump? Now I appreciate it's obviously there are certain areas that you can't get in too much into depth because it's sensitive, but what is it about your pneumatic pump that is different from a normal pump that gets oil out of the ground? Where exactly have you guys made headway? Let's say, is it in material science? Is it in the sensor technology? Is it the actual psi pressure that you guys can create with the motors there that get the oil out quicker? What exactly is it? Can you tell us a bit more about that?
Sure. I think the single biggest improvement is the lack of any moving parts above ground. That's where most of the damage and repairs come from. That's where the biggest costs usually come from. So that's been the biggest difference. The other thing to clarify is when we talk about this pneumatic pump, it's not a single pump. It's a multi-stage pump. So you actually have a series of pumps that are inserted into the well depending on the depth of the well.
Right.
And stop me if I go too much in depth here, because I don't want to confuse people either. But basically what happens is you have a series of pumps that go down, and then instead of traditional pumps that just constantly keep running, right? Like you saw in that animation, right? It's just constantly moving. It's moving up and down, and there's a bed that's constantly rotating the motors. That's not what happens here. In our case, there is the lowest stage pump actually has a sensor that determines when there is enough fluid that it makes sense to run. And when that happens, all of these pumps are in a series, and they will essentially almost play relay, and it will pass a batch of fluid from the lowest pump to the second lowest, to third lowest, to the highest, and that's when it will pump out into the fluid container. So it runs in a very different manner. It's fundamentally a very different structure than what happens with traditional wells or traditional pump jacks. Now, this is not something groundbreaking in terms of material science, and I actually like that. I don't like taking risks with technology that's, it's something that nobody's ever done before. This type of pneumatic pumping has been used for fluid, specifically water production, for a while. But oil production with it presents a few different challenges. It presents a risk of corrosion. It presents the acid issues in the ground.
Right.
You have sand and mud and things filtered that can damage the pumps. So a lot of this has been a question of trial and error and multiple iterations to design things to deal with every single one of those steps.
Right.
And that's really what we've been able to do. That's what we've ended up at.
You mentioned obviously pneumatic pumps being used in oil recovery and oil production, in water recovery and water production. So kind of taking a 2,000-3,000 foot view, can you tell me, obviously it's beyond oil. So this is the first step. These pumps can be reconfigured to get water out of the ground. What efforts are you making there? On that front, what type of horizon do you have in mind, time horizon? And what does an SOX holder, what does a Spectre, for example, because obviously the SOX contract runs for 10 years, correct? And that's on the oil fields. Does it need to be renewed after the 10 years once you get into water? Or is it something that one can swap SOPX for and make it come from water instead of oil?
So you cannot swap them. But as you receive new SOX, so right now you're on a compounding system, right? So every day you're receiving SOPX and you choose to convert it for new SOAX, right? So you're getting new access tokens. You will get to choose what you want to deploy that access token towards. Do you want to put it towards oil or water or natural gas or gold? And actually, far before we get to water, you would get to natural gas and gold, primarily because there is a significantly better cash flow structure in those commodities compared to water production. So you would be able to look at a similar calculator that we have for oil. You would have similar calculators for gold and natural gas, and you would make the determination which one you want to put that towards. Again, I would recommend, just from a diversification perspective, and that's available, you should do something like 50, 30, 20 and distribute it across all three. And what that will start doing is that over time, you're receiving production of natural gas, production of gold, production of oil, and so on. And it'll just keep climbing from there. So in this phase, we're talking about commodity production, which are already widely accepted. That's phase 2, actually, that we're now discussing, the commodity exchanges and multiple commodities and so on. Phase 3 would be somewhat blue sky technologies, right? Like technologies which are kind of out there in hydrogen production, in hydrogen management, microbial fuel cells, things like that.
Right.
That's very future focused, right? That's talking about stuff like, that would be like me talking about Neuralink. If I was Elon Musk and I was talking about Neuralink back in 2004, nobody would listen, right? So we don't really talk about that part as much, even though that's probably the thing I worked on way back, right? That's the thing that I worked on the earliest. In high school, I was working on microbial fuel cells. But moving forward, those are some of the things that we're going to start working on once we have everything in the basic commodity space done.
Got it.
So kind of like Tesla, they said, let's tackle something that everybody understands. Everybody understands cars, and everybody understands we can change the technology behind how cars operate. That's what we're doing right now. Everybody gets oil production. Let's change the technology around oil production to make it much more efficient, to make it much more attractive, to build a bigger profit margin. And then we can take that base and move to these additional technology that seem kind of out there at the moment.
Got it. Can you tell me a little bit about offtake agreements? How does it work there? So once the oil comes out of the ground, what processes do you have in place? Of course, without sacrificing anything that is sensitive, but can you tell us, are there guaranteed offtake, like you just sell it into the oil markets?
Yes.
What's the,
so keep in mind that we are not doing anything like oil exploration, right? So we're not going to a new area where we don't know what's going to happen, and then we have to go and find a buyer for oil. What we're doing is going to existing operators who already have offtake agreements in place.
Got it.
And we simply go to them and say, we are changing how your oil is being produced. And most of the time, we can easily, like there is not even a doubt, we could easily sell 15 to 20,000 barrels of oil per day right now without even getting into any new offtake agreements, because that market already exists. Midstream buyers already exist who take that up away from the fields that they've been buying from years. So that's really not an issue. As we expand, though, once we go into the multi-billion-dollar range, that's where we would have much bigger offtake agreements, usually with government structures. Like we have talked with Indonesia and we've talked with a few other places before.
Got it.
That's when we would go into those kind of scenarios. But that's far away, and it's honestly not something that affects the platform itself.
Okay. That's very useful. Hitesh, thank you. So next, we're going to talk a little bit about this initiative that we are creating in the industry, in the quote unquote blockchain / crypto, whatever you want to call the industry. And it's I think it begins with us, and it will roll out to more. Let me explain what exactly this is. This is DART, Decentralized Autonomous Revenue Token. We already have DALP, which is the Decentralized Autonomous Liquidity Pool. And SXDT and SOP are the first of multiple genuine cash flow driven projects within the DART initiative that we want to be adding over time. So over the next few months, as Hitesh already mentioned, SOP will be adding multiple commodities, gold, etc., water, natural gas. Did I get those right, Hitesh?
Correct. Yep.
And they will be launched within the Beyond Oil platform. So it's the back office that you see, and that has nothing to do with Spectre. It's a separate company, separate project. But effectively, what DART is, it's an ETF / token that holds on a unit basis revenue producing tokens, right? So these are effectively, you can call in certain instances like SXDT, it is a security, but in other instances, they may not necessarily be securities. But the bottom line is that it only invests at a various percentage level for each asset, or various concentration, if you will, in yielding actually resource or revenue backed tokens. And so it is to some degree the antithesis, if you will, to what is currently happening in DeFi, where you have a few ETFs being constructed, investing in tokens which are paying return in tokens, right? That's the whole token economy. That's the token inflation model. And it's literally printed out of fiat. If you actually drill down, if you get to the very bottom, there's very little value being created. So nothing can be more direct than a resource-backed token, right? Literally oil coming out of the ground, a portion of the profits after management fees being shared with the token holders. Nothing is more direct than that. And we effectively want to create a macro token, which, by the way, there will be no ICO or any fundraise or anything like that. So there's no worry there. The structure behind that, we will dish out over the next, in the foreseeable future at some point. But the important thing to note is that it is effectively, it will, or the aim at least, is to try and change the landscape for the slightly the better. Because currently the way the landscape is headed, yes, we're in a bull market, things are great, and that's fantastic, but eventually reality will set in if these business models that are just printing tokens out of thin air don't actually get underlying traction, and they actually start doing what they were meant to do, and disrupt the traditional industry, traditional finance, then there is a very, very, very painful lesson that lies ahead. And don't take it from me. I was actually very interested to speak to Hitesh about this in his own ETF discussions. Hitesh, you've said that you've received some insight, of course, without naming names, but people who have constructed some DeFi ETFs and what they had to say about the space currently.
Yes, absolutely. And I mean, I will tell you at least this much. We're talking about executives from one of the largest firms in the world, okay, one of the largest companies in the world, publicly traded companies. This is people who are telling us straight up, yes, we know people who have constructed these ETFs, and it's all hollow. And the analogy that we gave was, it's like somebody gives you a car as a gift, and it's wrapped in a very nice wrapping, and you open the wrap and there's just a box inside, and you open that box and there's another box inside, and at the end of the day it's all hollow inside. And that's what basically most of the DeFi blockchain projects out there are. It's all a question of how many users can you shuffle around and how much money is moving around, but it has nothing to do with real value being generated. The thing that is very unique about the two projects you see right now on the screen, SXDT and SOP, is both of them are built around underlying cash flows, underlying production, underlying value in the market that you can track, that you can verify. And that's not the case for almost anything else out there. So it's, I think you're being very, very polite right now. Okay, we could do much
well,
worse right now.
yeah, I reserved my words this time. Previously, I have been a bit more abusive on this state of the sector, but no, I totally agree, and I was quite happy to hear that, because it does goes to show that, okay, if there is any intelligence behind the construction of ETFs, anyone who has a brain would see that, you know, certain projects that are being included in these ETFs, it's a recipe for long-term disaster, and it will hurt the space. So again, we're not here as Mother Teresa to really save the space or anything. This space is doing fine, but the important thing is, as Hitesh said, the majority of projects out there right now in the space do not generate cash flow based yield. There are some, and there are some that are done very well, but it's few and far between. SXDT and SOP are two, and perhaps there are maybe 5 to 10 more, but then there's just a swath of garbage out there, which is, sorry to say, it is a Ponzi scheme, whichever way you want to slice and dice it. So what we want to do is create the antithesis to what you are seeing currently in the space. And the closest analogy that I can bring into the discussion is you have a range of APY yield farming, staking, whatever you want to call it, all that nonsense projects that are floating around right now, and they have billion-dollar valuations. And then you have a macro smart contract called Yearn, and there's now a few knockoffs of Yearn, if I'm not wrong, that actually automatically invest in these, correct, based on their APYs and their yield. So DART is literally that, but it's actually investing in real businesses that have varying degrees of value. Now, of course, Spectre is still very, very small. It's been 3 years, but it's still very small. We presented a webinar last week. We have made progress, but there's so much more room to go. But bottom line is, it generates, or it has generated 7,000 ETH in actual value, whether it's come from our investing, whether it's come from the actual quote unquote production, the trading. The bottom line is it's real value. With SOP, it actually takes things I would personally say, to a new level. It actually literally is taking value out of the ground of a commodity which is ubiquitous, which is one of the most important commodities today, and it's actually converting that into crystallizable value in the DeFi space, or in the tokenized space. There are more projects from different industries that we will include in this alliance. And when the time is right, then of course this thing will go live, and it will be an autonomous investing entity, so algorithmic, and of course it will be cross-chain, and that's really important to note, right? So take into account the inefficiencies that come with certain blockchains regarding gas and what have you. So again, I want to make it clear so that there's no hysteria and euphoria and all that nonsense that we've had historically. We're not doing an ICO here. We're not raising money here or anything like this with DART. This is something that will be done using a decentralized liquidity pool program, which has been done very well recently in DeFi. So effectively, people that were to partake in this would be doing so in a decentralized manner. And this autonomous entity would then go and invest and divest in these tokens under certain market conditions, right? And of course, that itself is a function of liquidity in these tokens, right? So obviously, Spectre Exchange will connect to this DART entity. SOP, by the nature of its token status, I think, Hitesh, if I'm not wrong, can be listed anywhere, right?
Correct. SOAX can be listed anywhere. SOPX can also be listed anywhere. SOX will not be listed just because there's no reason to list it, right? It's 10 cents. That's it. It's a utility token.
Yep.
But SOPX will indeed be on multiple markets, and we expect to trade at a premium in most of those markets.
Cool. All right. So we are at the end of the webinar. Let us turn over to Q&A. Hitesh, thank you for taking the time. I know it has been over an hour, and I think this may take a little bit of time as well because quite a few have come in. So let's start from the top. Okay, I see a question from Andy Bailey. Hitesh, this one's for you. He's asking, sorry, I didn't understand about the price at 60%. I think he means a 0.6x. He's asking, surely getting only 60% of a barrel price per token is against the SOPX holder, I'm assuming, to cover costs. Could you give a bit more color on that?
Yeah, sure. So the 60% means that whatever the current price of WTI is, then the redemption value of SOPX in our platform is 60% of that price. Mm-hmm. So when WTI is 100, then our redemption price is 60. Now, just so we're very clear, all the calculations that you saw on there, and when you put in the calculator, $55 as the price of WTI,
right.
it already accounts for that deduction. So it does reduce that by 60% in the math already. So you don't have to think that there's an additional haircut after the fact. So that's already addressed in the calculations. The reason why it's low by 60% is, lower to 60%, is because the way we receive that production from the operators, right? So SOP goes to an operator and says, we're going to cover the cost of equipment. We'll install this equipment on your wells. We're going to pull some oil out. We will take X amount of oil from you out of the production, and we will pay you half of what the current WTI price is, not full. And the operator is happy to do that because the operator knows that their production cost is much lower than that, right? That's how we're able to do it. So there has to be some margin built in there for the operator to be able to do so.
Right.
So that 60% of WTI price comes from there. Now, because we are working in a very wide range of locations, and there are differences in prices in all these locations, there are differences in labor costs and so on, 60% is a relatively safe figure that we don't believe we will have to adjust for a long time to come.
Got it. And effectively, it's a management fee for all the trouble kind of between you and the entire value chain that is involved.
No, it's not. So let me be very clear about this. That is
Sure.
not a management fee. We are not taking a piece of that, right? SOP as a platform actually makes its money on the oil production as well. Okay. So this is not a case of we have 40% margin built in. What I'm clarifying is that SOP itself does not receive oil production from an operator at the market price, right? We get it at the lower market price.
Okay.
And that's why you see that reflected in the token.
Understood. So effectively, it's a question of gross versus net revenues. That 40% is net revenues to you, right?
More or less. I think that's blanket wise. Yeah, that's a good way to speak about it in general. But I would advise anybody who wants to go into the details of that,
right.
You can read, there's an FAQ on our site on the homepage. You can read through that, or you can also read our white paper where this is also discussed in depth. So it kind of breaks that down and explains why there are margins there, how that works, and so on.
Got it. Okay. Thank you. Question from Jeff Wag. Thanks, guys. Very interesting project. How much maintenance do the solar-powered pumps require, and who is responsible for this? Hitesh, that's for you.
Yeah, the operators are responsible for it. SOP only functions as a capital partner and a technology partner, meaning we get them the capital, we connect them to the manufacturers of the pumping side and so on. The operator is responsible for maintaining those pumps and making sure that they're operational, just like they always have been, right? They are responsible for the traditional pump jacks. They are also responsible here. Now, they do, in case there's a problem, they do rely on our partners to come in and do any repairs or help with making the production better and so on.
Right.
But largely, it's the operator's job. It's their liability to make sure it keeps running. Very actually good side answer to this is, maybe somebody hasn't thought of this yet, but SOP does not assume any liability in this process. Okay, so that's a very important thing that we should be all clear on. In case one of these oil wells explodes and kills somebody, it's not related to SOP at all. It is not our management fees. That's entirely to the operator. So that keeps us very well protected. It keeps us very safe and outside of that area of things. So the operator is responsible for the maintenance. The good thing is that in 4 years of data, we already know that there is virtually no maintenance required on these. And if there is any maintenance required, it is literally less than a day, in some cases a few hours, where you can have a person with the right equipment go over, pull out the pump, do the repairs, and put it back in. And in fact, on our site, if you go to the behind the scenes section, we actually have a video showing that process. We actually have a video that shows the pump being lifted out. The internals are shown. We actually have Gary on the video explaining what you're looking at and then putting it back in.
Understood. A question from Luis Fernandez. He's asking, are the SOPX tokens burned once exchanged to, let's say, USD, BTC, ETH,
yes,
etc.?
A very, very good question. So yes, when you redeem them on our platform, they are burned. So that's a very important factor here. So the way I like to describe this is a real world analysis. So when you receive SOPX, That's the same as somebody saying, I took a barrel of oil and I put it in my warehouse. Okay. But when you redeem it, that's like somebody saying, I sold my barrel of oil to a refinery and now it's destroyed. It has been converted into gasoline and jet fuel and pharmaceuticals, whatever. It's been converted into all those things. That crude oil has now ceased to exist. So that's how our platform treats it as well. When you redeem SOPX, it is gone. That particular token is destroyed and it does not continue to exist anymore beyond that. That is not the case for when it is just being traded, right? So when you're trading it on other exchanges, when we do get on other exchanges, that's not burning it, that's just trading around in a paper value format, similar to futures contracts, similar to an ETF structure. But on our platform itself, it is destroyed. And that's, again, a reason why we know that we have established the baseline price in the market. So it's not going to be trading at a discount because we've already established what the baseline is.
Right. Okay. Andy has a pretty detailed question, an interesting one. He's asking, can you talk a little bit about derivatives hedging? I'm assuming you are selling the barrels as they come out of the ground. What derivatives are held against the tokens, and will this be audited and visible? Please go ahead, Hitesh.
Yes, they will be audited and visible. They are not at the moment because the youth of our company, it's a relatively young platform. That's why we don't have that published. But we expect we'll be doing that on a semi-annual basis moving forward. It is, so there are two things, and actually you might have even noticed when I showed you the team and the partners, we actually have one of our partners is a commodities derivative trader. He's actually a hedge fund manager. That's his job, is to advise us on what to do with this capital. So there are two sections there. One is when capital comes in and has not yet been deployed, it goes into essentially safeguarding the capital against derivatives and holding futures and so on. And the second is when the oil is produced, but it has not yet been sold. Usually oil is sold, it's collected on site in a tank, and then it gets sold bi-weekly basis or once a month.
Got it.
During that time, it is also insured and protected. And usually that happens at the operator level, not at SOP level.
So the 40%, going back to the gentleman's previous question, that includes these costs, correct? That the operators swallow?
Correct.
Okay.
All of that is built into that.
Excellent. Good question, Andy. That was really good. I think Lewis has a follow-up. If you don't sell the SOPX tokens, what happens to the produced oil? If not sold, that will incur storage costs. And if sold, how do you keep it pegged to the WTI price?
Yeah, it's a very good question. So we do not, the sale of oil from the operators is independent of the sale of or movement of SOPX.
Yeah.
The SOPX redemption price, and I get that there can be a difference there, right? So let's say that we had oil produced this year, and then somebody held on to their SOPX for the next 6 years and they never redeem it, right? And they redeem it 6 years later. And now there's a difference in the price of oil. How do we cover that? That's one of the ways that we cover it is through the derivative trading and holding positions. That's one of the things there is to cover our risk on that. So the only risk that we take here is that there might be a differential between the price of SOPX at the time of redemption versus the price of oil when it was sold. Oil is never held in its physical form in a warehouse waiting for the SOPX to be sold. That's not how it works. Now that might be the case in some cases with gold. Okay, that we might do that because gold can be physically held like that without any issues. That's not the case for oil. So there is a potential differential risk there, but it's very minimal. We've already evaluated it, and that's one of the reasons why we do have capital specifically designed for that offset through derivative trading or holding futures and so on.
Yeah. In terms of, I mean, as a follow-up from Lewis's question, I have one of my own. Is there any finite limit that SOPX token holder can hold on to their unredeemed tokens for? So is there a limit where you force them to actually redeem them? And does it make sense to actually add such a?
No, it doesn't, and we don't do it at the moment. Very realistically speaking, I believe there will be scenarios like with Bitcoin where some people will have SOPX that they'll move into an Ethereum wallet and they'll never access again. It is realistically going to be scenarios like that, and that's one of the reasons why we don't put a limit or put a deadline of any kind.
Yeah.
At the moment, there is no such plan. Now, could that be the case for some other commodities or down the road? Possibly, but there is no such plan at the moment.
Right. Okay, that makes sense. Okay, I see a question from Dan. Lewis, does that answer your question? I see a question from Dan Pierce. Is this solar pump technology proven? How many kilowatts does the pump require? Hitesh, without getting into any sensitive information, what can you volunteer there?
Sure. Actually, honestly, I haven't discussed anything on this call yet that's not covered in more depth on our website and the white paper. So
Okay.
All of you are welcome to do that. You find all this information in there. Now, in terms of kilowatt, that's not how the pump works. So the pump does not work directly on electricity. What the pump runs on is specifically the compressed air. That's where majority of the electricity goes, is the compressor that actually compresses the air, and then we hold that in a compressed air tank. We call it an air battery or a tank battery, but not to be confused with an electric battery. So this air is what is used to move the fluid up through the ground. Okay, that's fundamentally that's what pneumatic pumping is. The amount of electricity that is required for the compressor to run depends on how large the compressor is and how many different pumps or well sites we're running off of that. So in some cases, we might have a single air compressor that then powers and basically runs 7 to 10 different oil wells in its nearby vicinity. But in other cases, you might have an isolated well where we have one small compressor that just runs that one particular well. So the answer is that it varies quite a bit. And if we need electrical connection or not, we might actually have scenarios where we don't need any electrical connections at all, because you might have electric batteries and solar panels available in that location. So it varies quite a bit. All of this is discussed in the white paper. I don't want to take up too much time just going into all of that, but it's very well studied. It is very well understood. This technology is proven. Before we ever tokenize this, okay, December 2020 is when we first tokenized this and opened the platform. We had 4 years of data on the pumping technology before that.
See a question from Stin Puteman. Assuming an oil portfolio has a specific and unchangeable amount of SOAX tokens which can be staked, what happens when a large amount is idle on the platform or third-party exchange in the future? I think Hitesh already answered this when Lewis asked something similar. So I'm just going to, Hitesh, do you want to answer that, or should I wait for him to get back if his question has already been answered?
I think he's asking something slightly different from Lewis as well, though. I think what he's also wanting to know is what happens if it goes two ways, right? Let's say somebody today came in and purchased $10 million worth of tokens. What would happen to that $10 million, right? Because it's not going to go into oil production tomorrow.
Right.
So what happens in that case is you would receive the SOAX, you would go to stake it, and you will be shown a timer. The timer will actually tell you how long it will be before this particular SOAX contract becomes active.
Cool.
And how long it will remain pending. Because we determine that based on how long it will be before we will actually have capital deployed. Now, right now, we're kind of in a unique place. Like I mentioned, we opened the platform after the oil production was already up and running.
Right.
So right now, when somebody comes in and they put in a small amount, like a couple $100,000, they start receiving oil production immediately, the very next day, because we simply take the oil production we already have going and allocate it to them. That's been the case with Spectre as well. But as we grow, that will not be the case, and we will actually have to wait. New capital will come in. The capital will need to wait usually between 5 to 7 days, up to 20 days is how long they'll have to wait for it to be deployed for them to start receiving oil production. So that's one section of his question, like idle capital sitting there. The second question, I think his was, what about idle SOAX, which has not been staked yet? And the answer is we don't wait for the staking part. Okay, so let's say you purchase SOAX today, but you don't stake it. We are still going to deploy that capital, and that capital is still going to go towards oil production. And when you do decide to stake your tokens, then you'll start participating in that production, whether it comes from that capital or not, because it's diversified and spooled in a way. So in both cases, you are well protected and well covered. The project continues on in every scenario.
Understood. Hitesh, this deployment period, incubation / deployment, whatever you want to call it, but you said 7 to 20 days. Does this actually mean that new pneumatic pumps are being put into sites that were predetermined or preordained to have pumps put on them, and that's the 20-day installation period? Or is it more paperwork related?
It can be both, but let me give you an example. So, and this again, I might be getting too granular here, and if I am, just stop me. But I think most of your audience is sophisticated enough; they probably want to know this stuff. So here's basically what happens. You go to an operator. We don't usually go to an operator that has nothing running. They already have production on their sites, right? Let's say they have 400 pump jacks running on their site. So we go to them and we say, look, we want to take 100 barrels of oil per day from you. And what we're going to now do is, over time, we're going to replace these 400 slowly and steadily, maybe 2 a day, 5 a day, 2 a week, whatever the cadence is that we figure out with them. We will replace these with the pneumatic pumps as time goes on. But we start receiving their oil production right away, because we're never going to deploy capital and not receive something at the same time. So usually because of that, the moment we start working with an operator, we're going to start receiving oil production at that time. We're not going to have to wait too long. Now, where the delay comes from is on three occasions. One is if we go to a field where they have 400 wells, but only 100 of them are operational. Now there's going to be a delay, right? Because we have to get the other 300 operating. There's some capital investment there, but it takes 10, 15 days for those to get turned back on or for the new pumps to go in. So that might be a delay. In other cases, it might be because there's legal paperwork where we are literally taking over the assets from them as well, where we are saying we want 50% working interest in these oil wells. When that happens, then there's paperwork delays. And there are so many random delays that can also occur, right? Yep. So this is all, we give an estimate that essentially protects us from the perspective of we don't want a stakeholder to have an expectation and then go in and see there was no production on a certain day. We don't want them to feel like something is amiss. So that's why we have all of these things kind of factored together, and we note that in there. And there could also be weather delays. There could be delays from natural disasters and so on. All of that is built into that. We put out a notice for each one of those incidents, if and when it happens. Thankfully, it hasn't happened yet. And again, all of this is covered in a little bit more depth inside the white paper.
See a question from Maria. How is the pumped oil from abandoned oil wells transported for refining? So I think she means downstream. Is it by lorries, by railroads, by pipelines to refineries? And who is responsible for the transporting?
It depends on the location. The person responsible is the operator. A good example is the Texas Panhandle location. In that location, you actually have very long-range pipelines that will transfer it straight to a refinery. In most of our fields, like the one in Oklahoma and so on, it's usually done by lorries. You have trucks that are specialized in it. They come and pick up the oil once a month or twice a month. Some usually in that cadence, they come and pick it up from the collection tanks where this oil is stored.
Okay.
The costs are covered by the operator. That's part of the net. It's baked into that.
Got it. Follow from Jeff Wag. Right now, I see the Mid-Southern Shallows portfolio as the only one that can be staked. How can we research the operator or operators of these sites?
We do not disclose the operators of the sites for multiple reasons. One of them, we don't disclose them because we don't want people going to them directly. That's also a pretty hazardous situation, and you don't know when you just don't know when a crazy person is going to show up at some oil field. So there's a lot of concerns there. So we don't expose any of the operators. We work with them directly. We do expose information on the portfolio, so you can see what the expected production is, what the history is. You can see some of those basic details. We do have certain operators that have agreed to speak with people if needed. So if you are somebody who's looking to make a sizable token purchase, if you were somebody coming and saying, look, I want to purchase $500,000 worth of tokens, but I really want to do some more research, I would like to do a site visit, for example, that's perfectly fine. We do host site visits, so we can have some of the token holders come to the sites, meet the operator, meet the manufacturers, and talk with them if you would like.
I know, good question from Bart. If I remember well, Hitesh was connected to the Spectre project before. Does he still do? If yes, in what way? Can there be a conflict of interest? No, there's no conflict of interest because Hitesh, if you recall, had kickstarted volumes back in 2018. he gotten it off the ground effectively, and he has been an investor and owner in a range of businesses, and oil being a focus for many years. And I think now it came out of the garage basically after 4 years in testing, etc. So they got SOP out of the garage, I think, at the end of December or middle of December 2020, and that's when it's effectively got tokenized. So it's something that has been building in the back end. We only found out about it, I think, in September it was of last year. So
Yeah.
due diligence has been running since then. And with regards to conflict of interest, there's just there's no. I don't see how there can be a conflict of interest here. Ultimately, we're all aligned. When price of oil goes up, it's great for his company, for our company, for our token holders, and it's similar to Bitcoin, right? I mean, if Bitcoin goes up, it benefits us all. So there is no emoluments or any sort of uh, um, nefarious activities that need to be worried about, that could create conflicts of interest here. Also, in terms of the industries that we're in, we're not competitors in any single way, shape, or form, and we have no plans to ever get into oil besides just passive investing. So there is nothing here, and there's no business part of his that competes with any of ours. I hope that answers your question, Bart. Okay, good question from Dan Pierce. Is the pump patent owned by Solar Oil? Hitesh?
It is owned by Gary, who is part of the company. He's actually, him and I are equity partners on the actual oil production side of things. So Solar Oil on purpose does not hold the patent. We do hold, SOP does hold an exclusive to the patent, but Gary is the actual owner of that patent, and Gary is a co-owner in the actual oil operating company, the commodities portion inside of SOP. So for all intents and purposes, yes, you don't have to worry about somebody else going out there and doing the same thing. And if they want to, that's fine. They just have to pay some royalties.
Yeah. Okay. So a question from Ciplo. Do you keep the SOAX forever? It's a good question. I think he's probably referring to the 10-year period. So when that's elapsed, so to put it, does the SOAX then expire as well, Hitesh? I don't know if you answered that already.
Yep, it also expires and essentially gets burned away as well. We are all about trying to burn away things that have been used, because we don't want the same thing to be reused. Because remember, each SOAX essentially represents capital that has now gone towards installation of pumps or has gone towards manufacture of pumps and so on.
100%.
So you can't reuse that.
Yeah. Okay. I see a question from Neil. Going back to the slide with DART, with SXDT and SOP being two potential business verticals, my question is there potential for SXUT to unlock privileges across the DART verticals, or will SXUT be ring-fenced to Spectre? I'm conscious that may need conversations with legal. Yeah, it's a very good question. And of course, because we would be involved in such an initiative, because SXDT is one of the few tokens which has a multi-year track record of paying a relatively stable level of rewards, at first weekly and now monthly. The answer is we will, as best as possible, look to incorporate SXUT into the framework of however that project works. Whether SXUT acts as energy for this autonomous, quote unquote, smart contract that buys and sells these dividend yielding tokens, that's one potential configuration. I think as we build out this framework over the next, I'll say over this year, then we would also be able to reliably comment on that more, Neil. The important thing is the most important, I would say, wherewithals to make DART work are in place. You have two multi-million-dollar businesses, one with, arguably, not even arguably, I'd say humbly, much higher yield than the other. This project has, of course, certain risks, SOP, but its returns profile is more like a bond, if you will, right, based on oil prices to a certain degree. Whereas Spectre's returns profile is more speculative in that respect, but ultimately both generate value from actual production of value, whether it's coming from financial trading or whatever. So the important thing is that there's 2 tokens that are already ready to be subsumed or consumed by a DART. And there are more projects in the industry, some we know, that we will vet and we will invite to be part of this. So those are the most important things in terms of the actual frame, in terms of the actual exact mechanisms. What will SXDT unlock, etc. That's still something we would need more time on. Okay, a question from Bart. If I understood well, the SOAX covers a portfolio of wells and not only one well. So if one well has closed down due to, for example, regulatory reasons, I suppose this has a minimal impact on the SOX token, as it's only, for example, 3% of the portfolio. Can these 3% then be allocated to another well? Hitesh?
Yes, they automatically are.
Yeah.
So it's not even something that you have to think about doing. It's automatically happening. So remember, let's say I have an operator, they have 20 of our pumps running, one of them stops functioning for whatever reason. Now you have 19 of those working, but we also have 100 at some other location and 20 at another location, 5 at another. So the total production of oil that is coming in from all of them combined is what's getting distributed, right? That's what your SOX is giving you access to. So each individual well site is virtually irrelevant in the whole process.
Got it. Bart, does that answer your question? See a follow from Andy Bailey. Can I just follow up on the derivatives bit? It sounded like you may be taking a bit of a view on your oil in your hedging, parentheses, which may not be a bad thing, close parentheses, as there are parameters. Sorry, he's asking, are there parameters about how much of outstanding SOPX needs to be hedged and how much can be quote unquote played with? Hitesh?
Yes, yeah, there are parameters, and I think that it's not a fixed parameter. It's not like we have an internal guideline saying this is what we will do every time, because it depends very heavily on one, how much SOPX is outstanding. Second, what is the current price of oil? What are the expectations moving forward? Third, what is our internal projection looking like in terms of oil production on our side, right? Keep in mind, in the background, our oil production is going up month over month, and not even month over month, but almost daily. Our oil production that we have access to keeps climbing up as well. So that changes how much of outlying SOPX is a potential risk. 100 SOPX just being held by somebody could be a risk right at the beginning,
Right.
but a year later it's negligible amount, so it might not even matter. So a lot of this kind of has to be played by ear, and we have to keep an eye out on what's happening. We have a lot of the internal ideas around how to manage it, but it'll all be dictated by the market and how much SOPX does get held. So far, we're not seeing that happen. So far, we are seeing every single user is essentially compounding at 50% or more. Most are compounding at 75 or 100%. And there is no SOPX that's just being held. I think the highest SOPX we've seen held was 12 barrels, which was held in one account purely for testing purposes.
Got it. All right. I have a question from Lewis. He's asking, you have a patent on these pumps. Are there no other competitors with similar technologies?
No, there are other competitors, not with similar, they can't be pneumatic, but there are people who are always making improvements to oil production mechanisms. There are different ways that they do it. There are injection systems, there are jet systems, there's a lot out there, but none of them that we have investigated have been tested to such an extent or are as versatile as what these pumps are, these particular pneumatic pumps. And also none of them are as suitable because of the low cost and low cost of maintenance. They're not as suitable for these very low volume wells. Keep in mind, there are a lot of competing pumping technologies for oil wells that produce 80, 100, 200 barrels a day. Major companies fight over those wells. Shell, Exxon, Chevron, they're all out there. But our specific niche that we have found is these small, low volume stripper wells. This is our industry because these are the wells that are marginal and most operators struggle with. They don't want to work with them. So for us, it's like we are taking somebody's trash and turning it into a very valuable asset. And that's why this is such a good project from that perspective, because we're not trying to compete with an Exxon. Right. We have no interest in competing with them.
Got it. All right, question from Mr. M. What do you do with the risk on your books? Tokens stacked away on a wallet and never sold. Does that make sense, Hitesh, or should I ask him to rephrase
Yeah,
it?
it's no. I get exactly what he means. It is literally going to be noted as a liability, right? So from our perspective, SOPX that is held out there at a given moment in time literally represents the number of SOPX times the value of SOPX based on the price of oil. That's what the liability is on the books. Now, like I mentioned, so far that's been a non-issue because nobody is holding on to SOPX. Most people don't want to, right? Most people understand that the time value of money dictates that they should either liquidate their SOPX and buy more SOX, or they should liquidate it and buy something to hedge with, like gold or Bitcoin or whatever, right? So that's been a non-issue so far. But if it was to be an issue, it would be shown as a liability. Now, to be fair, it'll never be a very significant liability for us because no matter how much SOPX is held in somebody's wallet, that does mean that we already received the cash flow on the oil production from the operator, right? Like that oil was produced at some point, was sold, and we did receive the money for it. So it's never a significant liability.
Okay. See a follow-up from Bart. It was said in certain cases that solar panels could generate more energy than needed. The extra
Yes.
energy is then injected in the grid and generates extra revenue. Who receives this extra revenue? Is it the SOP company, or is this also distributed to token holders?
No, that has nothing to do with SOP and the token holders. That is fundamentally between the operator, the landowner. Just so you understand, this is a little bit more complex as well in terms of when you talk about an oil well, there are different entities that own the production rights, mineral rights, land rights. They can be different people there. So the person who houses the solar panels there would be the person that receives the subsidies, and there might be a completely different person that actually has a contract with a utility company to sell extra energy to them. So all of that happens between them. The reason why it's a very good thing to highlight, though, is that it makes a lot of these operators and site owners much more interested in working with us because they see that as a potential additional source of revenue and subsidies for them. So it makes it easier for us to acquire more assets and bring more oil production into the company, but it doesn't directly benefit us in terms of revenue.
Got it. Follow from Lewis. Just to clarify what I think you explained, with the automated compounding rebuy, will you be able to choose other types of contracts other than oil in the future?
Yes, you will be able to. Correct.
Okay. Okay, a good question from Kunle. Kunle is asking, you may be unwilling to disclose the operators to token holders for certain reasons, but are the operators disclosed to the management of Spectre.ai? So I can speak on this. The information in our own due diligence that we have done has looked at certain contracts between the company and certain operators. We've also looked at certain assays with when the studies were done and how much oil is in the ground. I think some of this information is on the website already, correct, Hitesh?
Correct. We have been able to add quite a bit more than what we had initially, but we cannot disclose necessarily the name of the operators themselves.
Yeah. I can say that we have seen certain contracts which had names on them, but we are under NDA as well, so we cannot disclose them. Okay, I see a question from Ciplo. Ciplo is asking, can you keep the uninvested SOX forever?
Yeah, you can literally just purchase SOX and you can hold it. You can choose not to stake it, although there is no value in doing so, in my opinion, right? The purpose that SOX exists is for you to stake it. So you do want to stake that. Now, if there is SOX just sitting in your account and you have auto staking option enabled, the system will take all the SOX that's sitting in your wallet, it will take that and stake it. It will do that automatically. But if you never stake, let's say you create an account right now and you buy 100,000 SOX tokens and you decide not to stake them and you just want to hold on to them because maybe sometime in the future you plan on selling the account or the underlying tokens. I don't know why somebody would do that, but you could do so and then it'll just sit there. However, like I mentioned before, on our side, we're going to assume they're going to be staked. So we are going to deploy the capital. We are going to get the oil production going, assuming that's going to be staked in the platform at some point.
Got it. Okay. We are approaching the end of our questions, so this is a last call for questions. If you have any final or outstanding questions, please ask them now. I'll take the final question now, at least so far, from Dan Pierce. He's saying, why did Solar Oil choose the token-funded route? What will their relations be with traditional oil players? Hitesh?
Sure. There are actually three reasons why we chose this route. And by the way, we did not choose this route exclusively. So this does not mean that we are not working with traditional large-scale investors or equipment financing and so on. We do work with all of those sources as well, however, under other companies. Solar Oil project is specifically the tokenization arm of our overall business model. So this is one of them. That's the first thing. The second thing that is interesting here is that we are not trying to build just an oil company. What we're trying to do is build tokenized commodity distribution, which has not yet been done. The reason why we think this is a very interesting space in the market is a lot of the things that have happened in the blockchain space in terms of trading and so on, they have found analogous systems to traditional markets, but that has not yet been done in commodity production. So we think this is a big opening in the market. And the aim is to bring in a very large user base into Beyond Oil based on kind of the carrot being, you can participate in the oil production right now and other commodity production. But really the aim is to develop a very mature commodity trading market that is driven by these tokens. The third reason is we think that we can actually command a much better price in the market on the paper value, specifically by rolling SOPX into other contracts, into other ETFs, things like that. We believe there's a significantly better multiple that we can get there than we would get in traditional markets at the moment, because they are heavily dominated by very large players, and it's not so easy to break into that. And Kay spoke to this a little bit earlier as well, where the paper value of a lot of these assets is significantly higher than anything else. And the final reason is the freedom that the tokenized market gives you. So the tokenized model that we are working with eliminates a lot of the questions around equities, liabilities, and so on, which allows us to operate with these operators in a very free sense. We can have JVs with them where we receive a portion of the production without necessarily taking on the risk of the underlying asset as well. We don't have to buy oil wells from them. While in traditional markets, we have to do that. We always have to take a working interest as well. So there are multiple reasons why we have chosen this route. It is not the only route we have chosen, but it is definitely the one that we have the most focus on and emphasis on, because we do think over time we will achieve close to 1 million users under Beyond Oil umbrella as a whole across all the different commodities. And like I've already mentioned, we can easily deploy between $2 to $6 billion in total capital in this market. So we feel like this can be something very, very significant. It's not going to be just a little blockchain project on the side.
Hitesh, I have a follow-up on Dan's question. Having said all of this, how much has already been invested across, let's say, so far, all the token holders and also the private investors that you're working through with other companies in the entire Beyond Oil project? How much invested capacity is there already in the ground in this project?
Sure. So some of it, keep in mind, I can't disclose some of it because it is also not part of the tokenized side, right? So we have, like I mentioned, we do have a lot of capital that has been put into this that is not part of the tokenized side.
Yep.
Significantly more so, right? Because it didn't exist for years. There was no tokenized side. Just since December 2020, we have multiple millions that have been invested, that have been used on the tokenized side itself. Okay, so just so we're clear, just on the tokenized side, it's multiple millions there. Before we launched the tokenized side, personally, we had put in 7 figures as well in developing this. And you can actually go to the site and look at the asset value of the reserve reports to see what reserves are available in the platform as a whole. Obviously, those are there because we have partnership interests or we have relationships in the background. Those assets represent a pretty sizable amount in the tens of millions at the minute.
Got it.
So it's a very mature project. Again, I just want to clarify because most people are used to seeing in the blockchain space an idea and a startup, but in our case, we really are approaching this in a very traditional sense in the beginning because we want to make sure that this is valid, there's real cash flows, there's a real business model there. And then on the tokenized side, we are very clear on what our mandate is. Our mandate is to increase oil production at a low cost. That's really our clear and simple mandate on the tokenized side, because that's all we care about, right? We care about how much oil production we get. We don't care about how many oil wells you buy. We don't care about how many pumps that get deployed. We care about how much oil production comes out. So it's a very different way to approach the same market. We feel like this makes us much more efficient. It makes us much more nimble compared to how traditional markets operate. Equipment finance market, for example, in the oil and gas industry takes anywhere from 2 to 6 months for a very small deployment, and it comes with a lot of caveats. That's not the case for the token market. So we really think we can really dominate this particular space, the stripper well mining technology space. We think we can really dominate because of the tokenization as well.
Yeah. And I have a follow-up from Ciplo. He's saying, so Hitesh told us that SOAX will be limited at some times, but does that affect the compounding? Hitesh?
Yes, it does affect it at that point, because you can't infinitely compound. Nothing can be infinitely compounded, despite what half of the DeFi projects out there will tell you. You can't infinitely compound anything. So there's obviously a limit on how many oil wells we can go and how much oil production we can tap into at a given point in time, right? We're always trying to improve it, increase it, but there's a heavy limit. So theoretically, there are going to be scenarios where you have SOPX that you've received, and then you say, I want to sell my oil and I want to buy more oil wells, or I want to buy more access, right? But there are no more available at the time. Our portfolios are exhausted, that it's completed. We don't have a new portfolio available at that moment. Now, realistically, we should not run into that scenario between oil and natural gas and gold, especially if we don't suddenly get an infusion of a few $100 million, which could happen. That's kind of how this industry is. It could happen, but we don't realistically see there being a scenario where we are completely out. But it could theoretically happen. And on those stages, that SOAX would accumulate in your account. And when new portfolio gets added in or new production capacity comes in, it would get staked for you at that time. Now, you might also be able to say, I just don't want to do that. I just want to keep collecting my SOPX and I'll convert that to something else. So keep in mind, it doesn't stop you from earning production on your existing stuff. You just won't be able to buy new SOX because there's no new SOX available at that moment. But again, this is a very theoretical scenario. We don't know if and when this would occur. And we would literally have to have capital infusion of a few $100 million to come in immediately for us to hit that limit.
Okay, Doug. So I see no further questions from anybody. And so I will assume that everything has been answered. If you have any outstanding questions about the Spectre side of things, but as always, get in touch with ir@spectre.ai. The recording of this should be on the token holder portal. The token holder portal itself will be down for about a month as we undergo the change to the new smart contract. And in the meantime, what we are going to be doing is putting this up when it's gone through legal on the Spectre YouTube channel. So by all means, if you missed this webinar or whatever, you can go and view it there. Now, one very important thing to note, and I think I've made it pretty amply clear on this webinar, also at the beginning, the risk warning. This is a high-risk investment, whichever way you slice and dice it, right? We have done our due diligence. We've done more due diligence on this one and a few others than we do usually because of its size. We believe asymmetrically it will return a considerable amount if oil remains where it is, factoring in execution difficulties over the next 240 months, right? Having said that, this does not mean, and this should not serve as a green flag for retail investors to say, yes, so because Spectre has done the due diligence, it's going to work out. That's actually not true at all. We get investments wrong as well. We get more investments right than we do wrong, and that's why our funds perform well over the last few years. But if you have any doubts, if you have any concerns, if you have any questions that you have not been able to discuss on this webinar for whatever reason, do not bring them to us. We are not associated operationally with this project. Take them directly to Hitesh and his team, and they will be very happy to answer it. As you can see, Hitesh is ridiculously competent, in my own opinion, and he really understands the space, but he is therefore the best person to also address your questions on risks and what have you. Also, as a corollary to that point, we are not running support for Hitesh's platform or the Beyond Oil platform or this project at all, right? So just because Spectre has made an investment in order to yield SXDT buyback from energy revenues, it does not mean that we are answering support on their behalf for you. If something is wrong in their platform, if withdrawals are delayed for whatever reason, if you can't access the platform, whatever, this is a task for their support team, just to be clear. So on that cheerful note, we will see you very soon. And thank you for attending. We appreciate all the feedback as well and the questions.